Hello and welcome to Share Views, brought to you by London South East. My name's Ed Bauscher, and in this edition we're going to speak to Jeremy Asher, Chairman of Tower Resources, an AIM-listed oil exploration company. So Jeremy, hello and thanks for joining us.
Thank you, it's a pleasure to be here.
So you've just put out an announcement about your Namibian assets. You've started talking to a major oil company about possibly developing those assets together. Can you tell us a bit more about where we're at in those discussions?
Certainly. First of all, the discussions themselves are confidential, so I can't talk specifically to those. But what I can do is explain the background to these blocks and why they're of interest to a major. Namibia is an interesting area in the oil and gas business because it's relatively underexplored. And that's because up until a couple of decades ago, and despite a gas discovery offshore Namibia several decades ago, there was the sense that the oil was not to be found south of Angola, just as in South America there was the sense that there wasn't much oil to be found in Brazil. And over the last couple of decades, that view's changed, first with the big pre-salt discoveries in Brazil, but also a better understanding generally of the geology of the Atlantic margin and the analogues on the other side of the Atlantic. And so there's been a lot more interest in Namibia over the last decade, but it's still very early days. Now, the majors like the opportunity because in the deep water offshore, you've got some really big structures, and so this is an exploration opportunity for them that can really move the needle.
And Exxon are exploring nearby to your license, is that right?
Yeah, well, not just Exxon, but Exxon have been very active in the area and have taken blocks both to the north of us and all the way up to the border and across the border in Angola, where they're already active, and also to the south of us. And we also have other interesting neighbours. Tullow have farmed in and have been drilling immediately also to the southwest of us and so forth. But Shell and BP have been active in the area in the past, and of course we originally, when we were first looking at this area with these blocks, we farmed out to Repsol, who drilled the Witcher well with us immediately to the south of where we are now. So this is an area that attracts interest from the majors, and for good reason. The potential size of the structures is big, and although the exploration wells that have been drilled in the last few years haven't yet uncovered a major oil reservoir, we've identified source rocks, and it's clear that there are reservoirs and seals. The issue that everyone's trying to get a handle on is where exactly the oil has migrated to, how it's migrated into which traps. We've got plenty of traps on this block. We've got still several very large four-way dip closures in the deeper water section of the block, similar to what we looked at with Repsol. And these are billion-barrel plus prospects. But there's also a number of good structures in the Dolphin Graben, which is where Norsk Hydro drilled wells a few years ago before we took the blocks, and where they had oil shows in the core samples, which give us a good idea of what source rocks have been feeding the Dolphin Graben.
But it's fair to say these are still high-risk assets. It's a long way until you're able to get to the stage where you know where the oil is and you can definitely get it out commercially and make a profit. Is that fair?
Yes, I'd say that of our portfolio, this is still the most early stage in exploration, in the sense that we've got big structures, but we haven't yet in this area got an existing oil discovery, whereas in South Africa we've got very prospective blocks with some interesting structures on them. But in particular, after Total drilled their Brulpada well next door block, and made a 1 billion barrel gas condensate discovery in the Utaniqua Basin. There, we've got a prospect in the same Utaniqua Basin that's now been proven up as a place to find oil by Total. But in the case of Cameroon, of course, we've got existing
Let's come back to
discovery.
South Africa and Cameroon in a minute. Let's just stick with Namibia.
Of the 3 licenses, this is the one that's the most early stage in terms of the discovery process.
Okay, we'll come back to Cameroon in a minute and South Africa. But just sticking with Namibia a bit longer, do you have any idea when these discussions with the major might end? When might we hope to see an announcement either way, do you think?
Well, we've got plenty of time because the initial exploration period's 4 years with the potential for another year's extension. So we have plenty of time both for work program and also for discussions. Nevertheless, I'd like to think that we'll have a good idea of where we're going with this particular discussion by the end of the year. So, within the next 3 months.
Okay, well, let's move on to Cameroon that you mentioned. These are assets where potentially you could be producing within a year, which sounds very exciting. Tell us more about that, and what are the chances of you achieving that target, or maybe in 2021 or 2022?
Well, provided we have our financing in place, I think the chance is extremely high because we've already got the discovery. We've got 18 million barrels of contingent resources just in one part of the discovery structure, which is what we're immediately planning to appraise and develop. Although, of course, with an appraisal well, we may still encounter unexpected problems, the likelihood of that's fairly low. The geological chance of success attributed to this appraisal well by the competent person doing the independent evaluation is a 90% chance of success.
Wow.
And that's not untypical for an appraisal well that's being drilled on a structure where you already have an existing well just a couple of kilometers away. So the issue that we're trying to address with the appraisal well is really the flow rate, how well the reservoir performs, and also because the original discovery well was towards the edge of the structure, we want to just see how the reservoir thickens. We can already see on the seismic that it's thickening, but we'd like to have a stronger data point on the extent of the thickening as we move towards the peak of the structure. So that's what the appraisal well's for, but it's not an exploration well, although it has exploration elements because we're getting exploration data. And the well is designed to be both the appraisal well and also the first of 4 producers. Now, once we've got that appraisal well done, I think there's very little risk at all. It's just the normal execution risk on drilling the remaining production wells, putting a light platform in, and bringing a mobile oil production unit to get into early production.
So there's plenty of oil there. There's just a chance you may find it's not so easy to get it out at a decent flow rate. That's the risk, and it's not a terribly high risk.
Yes, and if it doesn't flow well, it'll be unusual for the Rio del Rey. The wells immediately to the north in the Dasoni field, which is operated by Perenco, had initial flow rates of 3,000 barrels a day. Different reservoirs, so we can't just assume that we're going to get similar flow rate, but our base case assumption is 2,000 barrels a day, and that would be very commonplace in the Rio del Rey. So, and that's just the beginning. If we can do that, and 8,000 barrels a day is quite a lot of production and a lot of cash flow. It'll be generating over $100 million a year. From there, there's another potentially 18 million barrels in the same structure locked behind another fault, which may not be charged. But if it is charged, that would immediately double the proven reserves. And we'll find that out naturally when we do the initial 4-well development without any additional exploration cost.
Now, you mentioned finance. So, as I understand it, you need finance to pay for that appraisal well. I know you have a bridging loan facility at the moment, but what are you hoping to achieve to give you more finance to do that well and a longer-term finance arrangement? What are you hoping to do?
Well, we want to farm out. I think that
this Cameroon asset.
we've established that the The debt market is available to us, but only after this appraisal well's drilled. We don't want to ask our shareholders to finance this whole well. What we want to do is bring in a partner, and we know we can do that. There's plenty of interest. But in this market environment, this is not the kind of situation where we can simply set a deadline and insist that everyone adheres to our perfect schedule. We have to work with people because the companies that we're talking to, they all have, for different reasons, a timing that works for them rather than for us. And so we have to be patient, and we have to keep the progress moving in the meantime, as we've been doing so far this year, which means that we've already got all the well design work done and the long lead items paid for and delivered to Douala. We need to keep the base ticking over with those long lead items, and we need to get the site survey done, which I discussed in the interims, which is not a huge amount of money. But we want to get that done in the next couple of months. And then hopefully once that's done, we'll also be in position to conclude Farmout that will get us moving on the appraisal well itself. Now, I think that at the moment, investors see the biggest risk on our Cameroon project as being our ability to farm out and our ability to finance that well.
Yeah.
Well, it doesn't have to be major. I mean, we're looking for another $12 million or so to finish the well. So it's not exactly major oil company territory. And in fact, that's part of the difficulty that for big companies, this is small, and the biggest companies view Cameroon as too small for them. So that's why Total left in the first place and Shell left in the first place. So for them to do a new country entry into Cameroon is not realistic. It's smaller companies that are doing West Africa, and we've got to accommodate their needs as well as our own.
So just to be clear, a partner would come in, probably take a majority stake in the field, and then but pay for all the costs going forward.
I don't think a majority, no. We've already got over $10 million in the license, and we need to remain the operator, because being an operator in Cameroon is something that not many companies are qualified to do, and we're one of them. But we're ready to give a pretty large chunk, and the terms of the farm out are not the issue. There's plenty of people who are very interested in farming in on the terms on offer. The problem for most of these companies is simply a matter of finance themselves. So there are not that many independents that are working in West Africa that have $12–15 million just sitting around loose. For quite a few years now, investors have been quite rightly telling companies that if they want to finance something, come and tell them what it is they want to have financed. But they're not giving companies blank checks or fighting funds of tens of millions of dollars to go look for assets. And in that environment, what that means is that if somebody wants to farm into something, they've either got to accumulate the cash from existing production if they have it, or sell an asset, or they themselves need to go back to shareholders. But in the end, it's a time-consuming process, and we have to be realistic and sympathetic about accommodating partners in order to bring them in.
Just quickly, tell us about your South African assets as well.
Well, South Africa is a joint venture with New Age, and when we went into that asset, which is around 2014, the Brulpada well was due to be drilled in 2016. And part of our thinking was that it'd be very exciting to see the result of that well, and that would either make it clear that it was worth putting a lot of extra time into that license or not, and also would attract other investors to it. Unfortunately, the well was when Total started drilling the well, they had a lot of problem with the currents in the area, and they had to abandon and bring a much bigger rig down to drill the well 2 years later in 2018. But actually, we took a lot of encouragement from that because we thought, boy, if Total is that keen to drill this well, they must have a very good sense about what they're going to find. And sure enough, they made a 1 billion barrel gas condensate discovery in February of this year in the Utaniqua Basin. Now, we're in the next door block. It's a fair distance over, but the Utaniqua Basin is a long, thin basin that extends across their license and into ours. And New Age have identified a 364 million barrel of oil equivalent prospect on the section of our license that includes the Utaniqua Basin. So it's a Brulpadda analogue. What we're expecting to see now is that Total is planning several more wells along the Utaniqua Basin and heading in our direction from where they are. So we're very excited about it. We want to do more seismic acquisition over the specific structure in the Utaniqua. Okay. And New Age are looking for a partner for both of us to help fund that. But with the excitement in the industry about Brulpadda, I'm quite confident that we'll get that.
That sounds promising. Oh.
Exactly, and then we'll see what happens. But it's a nice way to. Obviously, it's very nice to actually participate in the Brulpadda discovery for those companies that partnered Total in that. But the cash calls for the additional drilling are very high. So in the short term, it's a big funding problem for them. For us, it's very nice because we're at the other end of the play. But we don't have to put that money in for those additional wells. All we need to do is fund seismic at this stage. So it's a very comfortable position.
Before I lose you, I'd love to get your view on the oil price, bobbing around $60 at the moment. What are your thoughts, your best guess, if you like, of what might happen over the next year or so?
You know, nobody can call the oil price over a short period of time, but the oil price is something you can make more sense of over a long period, like a couple of years. And I think that the supply-demand balance for oil is fundamentally good. There's a lot of talk about slowing down of demand, or do we need fossil fuels and so on. But people who are not very familiar with the industry don't always understand that, number one, oil and gas and coal are very, very different fuels. And oil has a place in the energy mix and will have for quite a while. Demand for oil is not going down and is unlikely to go down in the short term. The issue of whether demand is growing by 1 million barrels a day in a year or 2 million barrels a day clouds the fact that it's growing still and is likely to remain so. Now, the other thing that people tend to forget is that there's several million barrels a day of oil that has to be replaced in terms of production because of the natural decline rate on existing fields. And the more oil that comes from shale and tight oil in the North American continent, the greater that problem is, because the decline rates on those projects are particularly high, much higher than on, say, those long-life Middle Eastern reserves. Yep. So the amount of oil that we need to replace every year is big and even growing at the moment. Now, replacing all that oil does require investment in appraisal, development, and so forth, and that in turn supports the oil price. The most interesting thing I can say in my mind about this is that when we saw the recent disruption of production from Saudi Arabia, of course, it's reasonably easy to replace the equipment and get the production back to where it was, particularly because Saudi wasn't operating at full capacity at the time. But it reminded us of how fragile that supply-demand balance is. And you take a few million barrels a day out, and it has already quite a big effect, even when everyone knows it's temporary. But it's worth remembering that without any drones flying over Saudi Arabia, that is happening, and more than happening, every single year naturally. Now, the other thing is that the cost of replacing these reserves isn't particularly cheap. And one of the reasons why I love our Cameroon project is that the total cost of the development of the contingent resources we've got is in single-digit dollars per barrel, but at the margin, people are talking $40, $50 a barrel at minimum to be replacing reserves in the Permian or in the ultra-deep water. And that's what's supporting the oil price at this sort of $60-ish range at the moment. I think it's good support.
Jeremy, we've run out of time, but thank you so much for joining us. You've been listening to Jeremy Asher, Chairman of Tower Resources. Thank you so much.
Thank you. It's a pleasure to be here.
And if you'd like to see some more of these videos from LSE, follow the London Southeast video channel on YouTube. Thank you for watching.